Hello, and welcome to our September 2025 market update. Lots been going on, so let's get right to it. You already know the team, so I'm going to go right past that. You know the underlying thesis because I want to get right into what's going on. Dow, as a close of business, actually last Thursday, Dow was up 876 for the year. S&P 500 a little over 13, and Nasdaq a little over 16. We're having a good, strong year. Here is the important thing. Here's the S&P 500. You see the 200-day moving average in green, the 50-day in red, and the 200 in black. All of them show a very strong positive uptrend. If you look back towards not quite the middle, but you can see the big drop. We already had a 15% correction back in March when they first, or was it April, when they first announced the tariffs. We've recovered significantly since then. That's the S&P 500. Dow Jones Industrial Average shows the same pattern. Whether the Dow confirms the S&P or the S&P confirms the Dow is meaningless. It's just they're both in the same direction. Interest rates slowly moving down. This is the 10-year, which is what most of the market focuses on. We've gone from a little under 5, it was 490, to now we're down to 405. And then what do we have in here? 414. And last week, we'll talk about this in a minute, the Fed dropped rates a quarter of a point, and it appears they are beginning a cycle of lowering interest rates. Current CD rates, you can see as the longer you go out, they're kind of flat on that, but those are your current certificate of deposit rates. Here is the yield curve. The black is a year ago, and as you can see, long-term rates were lower than short-term rates almost across the board. Now we're getting a more regular yield curve. As you can see, after about the second year, long rates are beating short-term rates. That's very positive for the economy. So, where are we going? We're going to cover these 5 issues: tariff and some updates, the Fed Reserve Conundrum, policy updates, the debt in focus, and the resilient market, and we're going to go in that in depth. So, this summer has been very unusual. As you know, August, September, and October are historically the weakest months during this year. However, we have had the best summer in the last 40 years. 10 of the 11 S&P sectors are up. We had one decline, 2.5%. So we've had a very good summer. And also on this next chart, you see that blue line is the S&P 500. At the very beginning, back at Liberation Day, that's when Trump first announced all of the across-the-board tariffs. And as you can see, as deals got struck, you see the U.S.-China agreement, then the tariffs for Europe, the Vietnam deal, the Japan deal, the European deal again, NVIDIA and revenue sharing. As those deals came back into place, the market has recovered substantially. So right now we have, whether we're going to have a tariff war or not, it looks like it's going to be not. We might feel more tariffs next year, but there's been so many offsetting issues, it's very hard to say. Looking at the chart on the right is really the most important. It looks like 80% of the tariffs will in fact be paid by consumers. 10% will be paid by the manufacturers, 10% will be paid by the suppliers. Also, artificial intelligence is giving them the ability to lower their manufacturing costs and increase efficiency. So that's yet to play out. Here's the Federal Reserve Board. Here's the issue. That chart in the middle is inflation. And as you can see, inflation has been dropping significantly. The issue the Fed had was we also had a strong job market. A strong job market being inflationary, more people working, meaning more people have money, rates go up. The jobless rate has actually been the unemployment rate has actually been going up a little. Now at 4.3%, it's the highest since October 21. In terms of rates going down, that is a positive. So here we go with our Fed. I put that at the top. Last, Wednesday, the Fed lowered the rate from down a quarter of a point to 4.25%. We are looking at projections of what they're going forward. We think they're going to end up between 2 and 3%. That's what they say. But as you know, with all government statements, what they say and what they do may turn out to be different. So we'll see where it's going. Now, the passage of the one big beautiful bill cost about 3.4 trillion. The interesting thing on that, however, look at the two bar charts underneath. 15% of the benefits went to business. 85% of the benefits of the one beautiful bill went to individuals. And what are those? One, if nothing had been done, we would have gone back to the 2017 tax rates, which would have been a substantial increase. Now, with that occurred, we're now keeping our current rates and they're staying lower. Standard deductions on the right have gone up, and as a new portion, standardized deductions, you get a standard deduction each year, they're now going to be inflation adjusted. That has not happened in the past. Okay? Salt, wait a minute, what's salt? Oh yeah, I got to fool around with that. State and local taxes, big issue. They had been limited to $10,000. You had a lot of the high tax states really objecting. Now we're going to move it to $40,000 for this year. It will increase 1% a year through 2029, which is a big issue for a lot of the salt ones. And the deduction is reduced if you have income over $500,000. So we're going to see how this works out, but that's very positive. Senior deduction. They wanted to make Social Security tax-free for seniors. However, that could not have gone through the current legislation. To get it through as one bill, it would have had to have a separate bill, meaning it had to go back to the House, and that would have delayed it. Instead, they put in a senior deduction of up to $6,000. If you have single taxpayers over 75 grand, you get it. Married over 150, and then it actually starts to go down once you get over $250,000 in annual income. But there will be a senior deduction, which is an offset to Social Security. Next, estate taxes. Right now, it's basically, let's call it $10 short of 14,000, million per person. Husband and wife, 28 million. Next year it goes to 15 million per person, and starting in 27, it is adjusted for inflation. So that's very positive for individuals. Other provisions, it raised the amount of income you had to have for the alternative minimum tax. If you buy a car this year, existing loans don't work, but this year our trucks or recreational vehicles, there is no tax on the loan interest. It becomes deductible. The third one on the top, everyone knows this, no tax on tips. The IRS has already put out a list of jobs that qualify for that. No tax on overtime. Again, they've already put out an entire list of jobs that qualify that. And charitable deductions are now broader than they were before. Okay, this is a big issue, the new Trump account. For kids born, I guess I should say for children born this year, the Trump account will deposit $1,000 in their name to get them an investment account that is beginning. It's non-taxable, tax-free until they start to take it out. Starting next year, you can put in up to $5,000 per year, and anyone can put that money in. It can be you, parents, grandparents, friends, whatever. So that's going to be a very good things for kids. Not only does it start them with an investment account early, but it gets them used to the idea of investing, which is where we fail a lot with today's kids. The impact of the tax bill is still to be negotiated or still to be turned out. We raised the ceiling quite a bit. Excuse me. We may see a big jump in the total debt. That's yet to be worked out. We got to see what happens the next couple of years. Right now, middle column, we've got 5 days into next week where we may have a government shutdown. However, I want you to go to the far right bottom. When all of the previous government shutdowns have come, they've never really had a substantial impact. Short term, yes. Long term, no. The average rate of return on all of them was 13.5% 12 months later, so not a big issue. This summer, we have had a much better season than expected. Earnings have come in better than expectations across the board. If you look on the chart on the right, the 81% are technology companies, the 76% are non-tech companies. Both tech and non-tech companies have been beating expectations. This just came out yesterday. Well, depends on when you see this. We had expected a 3% second quarter GDP. Look to the far right, you see the arrow. It came out 3.8. We do have a healthy economy. As we all know, we've seen the biggest benefits in earnings coming out of the technology sector. Those darker tall lines are all technology. That is heading it up the board. I've heard frequently, excuse me, is this like the dot-com bubble? No, and here's the reason. Dot-com, no sales, no earnings, no products, all to come. AI, they're seeing actual results, bottom line results coming in now. They are real. All right, here in the short term, yes, are we overpriced? Are we in the high end? Yes, as you can see, we're in the 96th percentile. Some of you may remember back in, oh God, it's got to be 76 or 70. Alan Greenspan with his irrational exuberance. He just happened to be 2 years ahead of when the market corrected. How long can we stay overvalued? There's a long time. Earnings are coming in much stronger than expected. So am I concerned about this? No, I watch it, but I'm not concerned. So going forward, our estimates are moving higher and higher. And why? Who drives the economy? Consumers. And if you look on the right, consumers remain healthy in aggregate. They are still spending a lot of money. As a matter of fact, I thought I had this coming up. As of Friday, whoops, I'm going to go back for a second. In this slide here, you can see that first paragraph on the right. Americans spent more than initially estimated in the second quarter on services such as restaurants, healthcare, insurance, and transportation. The consumer is still driving the market. So we're seeing it across the board. It's still strong. So right now, what do we think we're going to see forward? I think you're going to see earnings estimates have gone down when they were worried about the tariffs. And you're already seeing earnings estimates as you see that curve start to go back. Forward estimates are now being revised and revised upwards. We have a couple of things to figure out about the tariffs. We have more impact in front of us. You know, a lot of people are just now used to the idea that we're going to have tariffs. And the technical indicators, yes, we're on the overbought side, but everything, the momentum remains strong. Momentum is driven by institutions. They remain net buyers. So, how do we put it all together? Number one, the market to this point has been driven by uncertainty. Uncertainty on tariffs, uncertainty on tax rates, and uncertainty on profitability. A lot of that has been addressed and cleared up. Many of those issues are now being better resolved. Number three, lower tariffs have been negotiated with many countries. The pattern is very clear. He puts on a big tariff rate. Everybody jumps up and down, and they come back with lower tariffs. Remember this about the tariffs. The tariffs in effect now were put in after World War II. At the end of World War II, both Europe and Japan's industrial base was devastated. Here we are 70 years later. Europe's industrial base is no longer devastated. Japan's is no longer devastated. The tariffs that were put in place, the economic conditions have totally changed. And that's what the administration is trying to address. Okay, number four, tax rates, as we all know, were set to go up in 2026. That one big beautiful bill replaced it with the current lower tax rates. 85% of the benefits went to individuals. And here's what we have for earnings. Number five, for the S&P 500, 81% of companies that have reported have exceeded earnings estimates. And finally, number 6, just to show the strength is broad, 10 of the 11 Standard & Poor's sectors have been positive over the summer months. This has been the summer that surprised many. So what we try to do is take all this information, put in a historical perspective, add some rational thinking to it. We have a strong market. There's every indication that it's going to continue. The fundamentals are good. The market is good. We're at the beginning of a Fed cycle lowering interest rate, which historically has created bull markets. So other than that, I think we're all in good shape. That's it. Thank you for joining us today. And as always, remember, we're here looking out for you.